If you've lost money in the stock market and you feel bad about it, don't worry. Ask somebody else about their losses and you'll soon feel much better because you'll realize that you have lost much less than they. So goes the joke about investing in the stock market. Did you know that investing in the stock market can be risky business? In fact, estimates show that as many as 90% of all investors lose their money in the stock markets. And this includes both experienced and new investors. Have I scared you? Have I surprised you? Have I shocked you? When we return, we will see why many people lose their investments and how you can minimize or avoid the risk of losing your money when you invest. Hello everyone, my name is JP of JP Financial and Accounting, Everyday Finance Made Simple. On this channel, we try to train, to coach, and to equip you with relevant money management skills. And of course, we try to glean as much wisdom as possible from scripture. I intend this to be a two-part video series in which we will look at investing. In this first part, we'll define a few terms and we'll also look at why basically people lose money when they invest. I guess the best place to start is ask the question, what is investing? To invest is to allocate money in the expectation of some benefit in future. In finance, the benefit from an investment is called a return. So you will hear us using the term return many times. The second question to answer is, what is risk? I've spoken about risk of losing your money. What is the definition of risk? Again, in financial terms, when we talk of risk, we are referring to the degree of uncertainty and potential financial loss inherent in an investment decision. And when you talk to experts about investing, you'll hear them many times referring to what they call investment assets. What are investment assets? An investment asset is an item that is purchased with the hope that it will generate income or appreciate in value at some point in the future. I'll give you a few examples of investment assets. The first one on my list is cash and cash equivalents. These are short-term investment assets. Normally, you are looking at a term of 3 or so months. Treasury bills are a good example of cash and cash equivalents. The next item on my list is fixed income or bonds. In practice, there are two types of bonds that are in circulation. The first one is the government bonds, and the second one is what we refer to as corporate bonds. They work in a similar way, although government bonds are seen as less risky. The third investment asset on my list is what we call equities. Normally, these are referred to as stocks and shares. This is what we'll be looking at for most part in this video and in the next. The fourth investment asset on my list is real estate. That is both commercial and residential real estate. When we are talking real estate, we are talking about investing in buildings, houses, so forth and so on. Fifth on my list, you are looking at what is referred to as commodities. Examples of these are precious metals like gold, the Krugerrand coins, oil, grain, etc. Sixth on my list of investment assets is what is known as futures or other financial derivatives like investing in currencies. Seventh on my list is what we call cryptocurrencies. And a good example of this is Bitcoins. As I said earlier on, in this video, I do not intend to go through the whole entire list of these investment assets, but I would like to briefly look at equities or investing in the stock market. The stock market refers to a collection of markets and exchanges where regular activities of buying and selling and issuance of shares of publicly held companies takes place. The way I think of the stock market is if it were a supermarket. In a supermarket, you have several aisles. Fruit and vegetable aisle, the bakery aisle, there is the dairy products aisle, there is the frozen foods aisle. The stock market is set up in a similar way. You buy shares of many different companies. Apple stocks are on sale, Samsung stocks are on sale, Amazon, BP, Tesco, think of them, all the big public listed companies. Their shares are listed on the stock market and you can buy them as and when you wish. Perhaps the most important thing to remember as a beginner investor is that shares are not like a lottery ticket where you are gambling. But when you buy shares, you are buying or purchasing a small part, a tiny part of a company or a business. For example, Apple has about 4.5 billion issued shares. If you buy one Apple share, it's like you're buying a tiny bit of Apple, because remember, there's another 4.5 billion shares that are on sale. And depending on how you purchase your shares, you can actually buy a fraction of a share. Not the whole share, but just a small fraction of one share. And because you're buying just a fraction of a business when you purchase a share, so it is not gambling. When the business does well, your investment will grow. But if a business does badly, your investment will shrink. And it is then possible that you could lose some of your investment, or in the worst case scenarios, you lose everything. How then can you minimize your risk when investing? To answer this question, you need to understand the different investing strategies that you can adopt when investing in the stock market. Broadly speaking, there are two investing strategies that one can adopt. You can either be an active investor or a passive investor. Active investing is a hands-on approach which often involves trading on the stock market. What is trading, you may ask? Trading is a form of speculation in shares and securities. Typically, a trader buys and sells financial instruments within the same trading day, and sometimes they do this several times a day. This is the riskiest investment strategy, and I would urge all beginner investors to avoid, because day traders are typically well-educated guys, they are well-funded, and they earn six-figure salaries, and they work as many as 20 hours a day. As a beginner, I would strongly advise that you stay away from trading. But if you really insist on trying trading, the good news is that there are many platforms which allow you to open practice accounts where you can learn and practice how to trade without risking your savings using fake money. I personally have been messing around with the Trading 212 app, but I have not got to a point where I think I am confident enough to invest. As I was preparing for this video, I came across a very interesting fact. A customer account audit by the investment firm Fidelity INVESTMENTS revealed that their most successful investors were either dead or inactive. In this instance, inactive refers to people who made their investments, forgot about them, and moved on. You see, that's the problem with active investing, is that when people are actively looking at their investments on a regular basis, when they see the price of their stocks going down, they panic, sell, and as a result, they lose money. Whereas inactive or passive investors or dead people, once they invest on the long haul. They leave their money in that investment over a long period of time. And because the stock market generally grows in value over a long period of time, and then your investment yields a return. I have a personal success story investing. A few years ago, I decided I was going to invest a fixed amount on a monthly basis. And after 10 years, my investment had grown 7.5 times. I do not wish to burden you with the numbers, but imagine if you invested £1,000, you get back £7,500. That's a lot of money. You see, patience is the key to investing. And on this one, I would urge you not to just take my word for it. Ask the experts. Warren Buffett is considered to be an expert in investing. He is considered to be one of the most successful investors in the world, or one of the most successful investors the world has ever seen. He has a net worth of $80 billion. Here are some of the famous or well-known quotes from Warren Buffett. According to Warren Buffett, rule number 1 of investing, never lose money. Rule number 2, never forget rule number 1. Another famous quote from Warren Buffett: the stock market is designed to transfer money from the active to the patient. Another famous quotation from Warren Buffett is, if you aren't thinking about owning a stock for 10 years, don't even think about owning it for 10 minutes. Another interesting one, Warren Buffett says, diversification is protection against ignorance. It makes little sense if you know what you are doing. What are the takeaways from these quotations from Warren Buffett? The first one, he says, never lose money. Why does he give that advice? Because as we have said before, 90% of the people take too many risks in the stock market and they end up losing money. Number two, what we learn from Warren Buffett is, if you leave your money in the stock exchange for a long period of time, inevitably you are going to make money. But if you rush and start tinkering around, you are likely to lose money. That's why we have this high number of people that lose money. This is why he says the stock market was designed to transfer money from the active to the patient. Notice the time periods that we are talking about here. We're not talking about a day or 2 or 3 months. We are talking of a number of years, 10 years, 20 years, 30 years, 40 years. Did you know that if you invested £300 a month, if we are looking at the historical growth in the stock market, after 40 years, that £300 a month will have grown into £1 million. That's a sure way of becoming a millionaire. Looking at the quotation, diversification is protection against ignorance. So I would say, if you are ignorant, if you do not know what you are doing, don't go about trading in the stock market. Instead, diversify your investment. That way, you minimize the risk of losing money. We will look at diversification in the next video. On this note then, what are the next steps? What do you need to do if you intend to start investing now? Phil Town, another successful hedge fund manager, suggests that new investors should follow the following steps. Step number 1, pay off your bad debts and avoid money traps. What does he mean by bad debts? He's talking about unnecessary debt. We spoke about unnecessary debt in another video, which I'll link below. Your mortgage, student loans are not considered to be bad debt. Step number 2, create an emergency fund. We spoke about saving for the rainy day in another video. Again, I'll link it below, how you should save for the rainy day or how you create an emergency fund. The third step, according to Phil Town, is learn investing basics. In other words, he's saying try and research a bit, do a bit of research about how you invest. He uses this very practical example. He says you can't jump into a swimming pool if you have no idea of the basics of swimming. In the same way, don't just jump into the money markets and start investing when you have no idea of what you are doing. So for now, I would say try to read about index funds, ETFs, ISAs, to try and understand what these things mean. But of course, in my next video, I'll look at that also. I would also say start looking at different investing platforms. Vanguard, that's the one I personally use. Trading 212, look at eToro and try and find out what you can learn about this. Finally, let's go to our verse of the day. Today, our verse of the day is taken from Galatians chapter 6, verse 7 and 9. It reads, "A person will harvest what they plant. Let's not get tired of doing good, because in time we will have a harvest if we don't give up." I do realize that the scripture is written in another context. It is not talking about money and investments per se. However, the same principles are applicable. When we plant and we are patient and we don't give up, we reap a harvest. In Genesis chapter 29 verse 20, we read about the patience of Jacob. It reads, "So Jacob served 7 years to get Rachel, but they seemed like only a few days to him because of his love for her." From these verses, we glean the same advice that I've articulated earlier on. The message is simple. Invest, that is to plant, be patient, wait, and inevitably you reap a harvest. That's the principles that we get from the Bible. That's the principles or the lessons that we learn when we look at the history of investing. I thought in this first video, I'll address that risk factor because I do not want anyone to be losing money. I'll see you in the next video when I look at further steps that we need to take to begin our investing journey. I hope you've liked this video. I hope you've enjoyed it. And please do like the video. And if you're not already a subscriber on the channel, please do subscribe, as this will help me to reach a larger audience. This is how the YouTube algorithm works. It looks at the likes on a video. It looks at the number of subscribers on a channel to drive more traffic to the channel. Thank you very much. See you in the next video. Bye for now. God bless.